What is going on? Hello, SNB Nation. Today's the day. We got the Fed rate hike decision coming in hot 5 minutes from now. Everyone's expecting 50 basis points. I guarantee that's what it's going to be. They're not going to surprise right now. Um, but then we got that presser afterwards from JPowell. So it should be exciting. This should be a big day for the market. Um, I have no predictions going in. I am leaning downside, but I would not be surprised one bit if we skyrocket from here past 410. That is where I would love to see a breakout. We are still on the S&P sitting below this downtrend line. We're still below that freaking line. So let's see what happens there if we can finally break it. We are above the 200-day moving average at the moment, but yep, let's wait and see. We got 5 minutes, 4 minutes till that rate hike decision comes in. Let's queue up queue up fast stock market news. Get ready for the fireworks, baby. Get ready for the fireworks. Whew. It's been a solid green day, actually. I shouldn't say kind of green. It's been a nice, decently green day. Nasdaq's looking good, up almost 1%. Apple up 0.5%. S&P 3/4. My levels right now on the S&P. I think if we come down here below 403.50, we will see some pretty good downside. But main level for real downside on the S&P is way down at 392. We have our system sell signal sitting right here at this support, so we have a nice confluence right here. We have, oh, where we got this? We got a nice confluence at this really key level right here. That 30-minute 50 simple moving average sitting right there on that level at 399.20. If we get yanked below that violently, I think we'll see a lot of downside for the rest of this week and probably rest of this year. Main downside level though is way below that down here at 392. We come below that, and I'm thinking it's lights out on the market. Not on the market, but I'm thinking it's like next leg down. I think that's going to be like worst case scenario, and we're going to see a lot of downside. But the fact that we are ripping into this meeting has me a little worried, man. I'm not going to lie. What the hell is going on? Holy moly. Why are we up so much right now? We're up on really. Actually, it's not that low volume. It's actually decent volume today. How's about that? How's about that? Oh boy. FOMC day, boy. mRNA been doing today? Oh, it was ripping. Damn, mRNA going crazy right now. Look, days in a row mRNA had. Holy. Nvidia is another one I'm watching to the downside. But it does look like Nvidia is broken out of that downtrend that's had this entire year. So above 193 on Nvidia, I think we could see a lot of upside on Nvidia if we break that. That's like the main. That's right where we rejected last time. The downside, Nvidia. Gotta see. 178.20 on Nvidia below that. I like it to the downside. It has looked super duper overextended on this rally. What have we gone, like 60% now? Yeah, 70% off the bottom on Nvidia, and nothing. What has changed for Nvidia? Not a whole lot, if you ask me. Not a whole lot. Their outlook is bleak for the immediate future. All right. There we go. What do we got? Oh, we get a big red dingus. What do we got? What do we got? 50, 50? Refresh. And of course, this guy doesn't have it. I should have just been on unusual whales. Does anyone have it? Where is it? Damn it, Twitter. 50 basis points. No way. And we get a big red dingus off of that. Wow. How about that? Who'd have thunk? Who'd have thunk it? So this could be the typical fade the first move. Yep, 50 basis points. Um, what the fuck is this? China's state affiliate has decided to decrease interest rate after concluding. What? This is straight up Chinese fake news right here. This page, that tweet was deleted. Yeah, no shit. What the fuck? A Chinese media outlet comes out here and posts that. That's too funny. China's state affiliated media. What? God. Fake news be like. What VIX is doing today. Wow, VIX flat right now. It is flat on the day. Sheesh. Big red dingus. That's the big red dingus. Whoo! There goes Nvidia. Bye bye, baby. My puts are gonna print. Good night. There we go. There we go, Nvidia. To the downside. Oh, and there goes SPY. All right, baby. All right, is this it? Is this the bloodbath? Is this it, folks? Oh no. Hooey. Shoot. Damn, look at that big red candle on Nvidia. Fuck, dude, it's going for the gap fill. Let's see. I could easily, very easily see this just reversing. FOMC is very often fade the first move. The very initial reaction is the one that is incorrect and the one that eventually reverses. But as of right now, this is looking like a really strong red dingus. Let's see exactly where she goes from here. Puts are skyrocketing on Nvidia at the moment. Everything at the moment. TBH. SPY is bouncing right off that level. What did I say? That level. What did I say? 399.20. Look at that, bouncing right off of it. Damn near about 40 cents off that level. Bouncing, almost tapped that 50 simple moving average on a 30-minute. Very big deal. If we test that and bounce off of that, we could be out of here. We could see some sayonara to the upside. Man, Apple had a freaking red dingus right there, boy. Apple bouncing off trend right there. Square's looking nice to the downside too now. Sheesh. Big ol' red one. Ooh, look at that. See, Nvidia bouncing off that 30-minute simple moving average. That 50 simple moving average on the 30-minute. Look at that. Nvidia bouncing right off of that. Watch out. Damn, and AMD making some big move. Some big old move. Nah. Here we go. Now market's moving back up. Here we go. Initial fade. Fade the initial dump. It's always bearish when they hike rates. It's always bearish. No one likes higher rates. So every time they hike them, I mean 50, it is lower than it has been all year, but 50 in the grand scheme of things is still a very aggressive rate hike. And I think the market is probably going to digest that accordingly. That is no tiny little rate hike. That ain't no little 25 basis point rate hike. That is a big deal. Determining the rate hike pace, the Fed will consider cumulative tightening, policy lags, and economic financial developments. Only two policymakers predict a Fed funds rate of less than 5% by end of 2023. Ouch, dude. Ow. Ow. That must be what is yanking the market down right now. That is tight. That is very tight. 5% for the entire. So are at. We aren't even there yet. We're at 4.5 right now. So they want to go another 50 basis points and then stay there all throughout the entire next year. That's rough. That is not a U-turn anytime soon. Holy. Oh man, that's rough. That is rough. Inflation remains high. Fed is paying close attention to inflation risks and determining the rate hike pace. The Fed will consider cumulative tightening. Yeah, what the fuck? This has already been said. Job growth has been robust and the unemployment rate is low. AKA, we can still keep ripping up rates because unemployment hasn't even moved. They have been very aggressively tightening, and unemployment has been completely unaffected. That means, hey, keep tightening. The economy is still bustling. Keep on tightening. That's not good, folks. That ain't good. Ain't good. Ain't good. Not good. Indicators point to modest growth in spending and production. Job gains have been robust in recent months. The unemployment rate has remained low. Inflation remains elevated, reflecting supply and demand imbalances related to the pandemic, higher food, energy prices, broader pressures, Ukraine war. Uh, Decisions regarding monetary policy implementation. The Federal Reserve has made the following decisions to implement the monetary policy stance announced by the Federal Open Market Committee in its statement on December 14, 2022. The Board of Governors of the Federal Reserve System voted unanimously to raise the interest rate paid on reserve balances to 4.4%, effective starting tomorrow. As part of its policy decision, FOMC voted to authorize and direct Open Market Desk at the Federal Reserve Bank of New York, until instructed otherwise, to execute transactions in the system open market account in accordance with the following domestic policy directive. Range of 4. Conduct purchase agreement operations with a minimum bid. Calendar month that exceeds Yep. Man, we are dumping right now. Sheesh. There's the dump. All right. There it is, folks. Let's see. We still got time. Powell can come out and really change things. This is just the initial dump. Nothing to ride home about. And we are still. Look at this. We're still bouncing off that. We're still bouncing off that 30-minute simple moving average. Got to see a break below that to see some real downside. We have not, so we have not seen real downside. Alrighty then. Da, da, da. He seeks to achieve maximum employment, inflation at the rate of 2% over the longer run. In support of those goals, we decided a federal funds rate from 4.25% to 4.5%. Committee anticipates that ongoing increases in the target range will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. So I think the market was hoping that this might be the last one, that they would rate hike from this point and that would be it, and potentially lower it by sometime next year. But it is not sounding like that is where they're leaning towards. It's sounding like the opposite. It sounds like they want to raise it even more and keep it higher for longer. And that's a long time. 5% for a whole year is a very long time. We are going to see the full effect of that. I mean, yeah, it's going to be rough. It's going to be rough. It's gonna hurt earnings bad. Tech earnings, oh boy, tech earnings ain't gonna look pretty for that entire year, and that sucks. That's gonna be a lot of pricing in very shitty earnings going forward. Yikes. In addition, the committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities as is described in the plans for reducing the size of the Federal Reserve's balance sheet that were issued in May. The committee is strongly committed to, yeah, we know, get inflation to 2%, and in assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. Um, the committee's assessment will take into account a wide range of information, including readings on public health, labor market conditions, inflation pressures, and inflation expectations, and financial and international developments. So Russia, get out of fucking Ukraine, and maybe inflation will go down. So roll over at auction the amount of principal payments from the Federal Reserve's holdings of Treasury securities maturing in each calendar month that exceeds a cap of 60 billion per month. Oh my god. So they're just, yeah, they're letting shit roll off that balance sheet. Urgh. They're not buying anymore. They're selling. Well, look at that. We're still bouncing. We're still bouncing off of that, folks. We gotta see a definitive break below that. Gotta see it. We're just bouncing off of that, folks. Look at this. Big green dingus right there. Let's see. Let's see. Let's see. Right now, we have not gotten a change on this. We have not gotten a sell signal on the system. System is still a buy. Still a buy. And this guy trades on Robinhood. Very cool. Yeah, the Fed has been very transparent and consistent. They are not pivoting. That's just like, that's how the market's just been all year. Like, I don't get it. People, I mean, people really want them to pivot, so I think they just are willing to translate any dovishness from Powell as, oh, they're pivoting soon. Yeah, they're definitely about to pivot. I think that's just been every rally we've had in the stock market this year. And I mean, the CPI inflation is going down, so that has been part of it. But it is really no one. The stock market could not care less about inflation. It just cares about what the Fed is doing. Um, so that's really been the story of the market. That's just been all year. Just don't fight the Fed. That's all that's been happening this entire year. It's not inflation. It's just about what the Fed is going to do because of inflation. And that's why when you see quote unquote good unemployment numbers, you get downside on the stock market. It looks like we're recovering a little bit. A little bit. Like we're trying to get back over where we opened today, but I think I told y'all, I said a break of 403.52, that looks super bearish, and then a break of this level. But look at this level, we're holding it up strong right now, 399.20. We're bouncing right off of that. Key levels, perfect levels. I love when I come out and draw these levels and they end up just being completely perfect. Literally where the algos are holding it at the moment. Nvidia with that big old green dingus getting bought. Wow, that's a lot of buying on Nvidia. High volume buying right there. All right, so we got the press conference coming up in 15 minutes, and that's really going to be what the market looks at as the market hangs on every word that comes out of Powell's mouth. All right, T minus 15 minutes until that press conference, guys. Let's look around the market a little bit. Square, 0.5%. The Coinbase had a nice little squeezy little day today. IWM. Yeah, Russell 2000. Yeah, small caps are basically doing what the rest of the market's doing. Market's basically just lock 7, just right. Look at these levels, dude. That perfect level on the Nasdaq it's bouncing right off of. Perfect. Right there. I had the levels down perfectly, dude. It's crazy. I love that. TA, baby. No better feeling when you like go through, you designate levels and they end up being like perfect. Perfectly true. I would not be surprised one bit if we get a complete reversal and we just go straight up and we close up around here at like 295.50 or 296.50 rather on the Nasdaq or the triple Qs. Would not be surprised at all by that. Not one bit. Easily happen if Powell says one thing wrong. But that's the other thing. These people, they act like they don't look at the stock market, but of course they look at the stock market. They run the Federal Reserve. Of course they see what's happening in the stock market. They know where the S&P is at right now. They know it's at the peak of this rally. What makes you think they want to be like, yeah, let's keep this rally going? It'd be great if the stock market rallied another 10% before we even have inflation down to where we want it. I don't think that's what they want. I think they're gonna. I mean, these people aren't stupid. People act like, yeah, they don't know what the stock market. They fucking do. They know that they control this shit. They know they do. They know they do. It's a fact. A freaking fact. It's plain as day. They know that they can move the stock market to their will. Like Powell did it over here. He dropped it 3.5% in one speech over about 20 minutes. I mean, it's absolutely possible. So. Gotta keep that in mind. All these different factors we got right now. This is the big FOMC though, last of the year. I think this dictates whether or not we do get that Santa rally at the end of the year, that last week of the year. This kind of dictates if that happens or not. Any data coming out after this? So tomorrow we have retail sales, we have unemployment data. So tomorrow's gonna be big too. We can get if we get like unemployment data that unemployment went down again, dude, that's gonna be like more of Fed can just keep jacking up rates, man. They want to see unemployment go up, but they aren't seeing that. So we have initial claims unemployment tomorrow. That's gonna be a big one. Retail sales as well. Tell us all about the consumer. That's the story. It's all about the Fed, all about the consumer. Not so much about inflation, just what happens from inflation. But clearly, low inflation has been bullish this year. And we have next week a bunch of housing data, personal income, PCE prices. So that's also pretty big. PCE prices. That's more inflation data coming in next week on Thursday, I believe. More unemployment data next week as well. And I think we have a full week. Yeah, we do. We get a consumer confidence read after that. Chicago PMI. Interesting. It could be an eventful final week of the year. I'm thinking it will be quite eventful. And looks like right now we are getting some bearish consolidation. And look at NVIDIA, it's bouncing right off that level, right off of that 178 level. Having a hard time getting back over there. S&P, we were just making like a perfect little bear flag right here. Let's see what happens. I mean, the market's just gonna wait. We got 10 minutes until until Powell comes out. So we'll have to wait and see. Wait and see. Wait and see. See what the folks are saying. Highest levels in 15 years. Interest rates. Gotta love that. If that's not the most bullish thing I've ever heard, then I don't know what is. Highest interest rates in 15 goddamn years. It's crazy.
Likely that inflation is going to be not getting down below the 3% level, and that it's going to take a while longer than that. And so right now, they've only gone to sort of moderate tightening. It's not really, in fact, they've just really gotten to neutral just fairly recently. So from that perspective, I think that
but that's using current inflation. And inflation, as you know, is a lagging indicator. I mean, the inflation we're experiencing now is from monetary policy that was set into place 18 months ago.
Absolutely, but in terms of actually the kind of numbers that we see in terms of looking forward to what we think inflation is going to be, we don't really see numbers below 3% for a while. Now, I could be, actually, we might get lucky, and in fact, inflation would go below that. But I think expectations are really that inflation is still well above the Fed's target. And from that viewpoint, for quite a period of time, I'd like to see the Fed be a little bit tighter because they were a little bit too easy earlier on. So this is actually a judgment call.
Skyrocketing.
I think really
the dollar
skyrocketed. Is that the Fed actually signaled that they're not going to just cave in and start to pause too early. That's what I really worry about. So in that case, it's not so much that I worry about the actual rise this time, but just where they're heading to, and that do they actually are willing to actually say that the risks that are more dangerous right now are not getting inflation under control rather than having the economy go into recession. And that's always a balance. But I think that there are a lot of people saying, gee, we're going to have a recession. Isn't that terrible? But in fact, in order to get inflation under control, that's what the Fed is going to have to do. You could look at past episodes that you always get a slowing in the economy when you're actually trying to get inflation under control. And that's even more true when you've actually gotten a little bit behind the curve, as the Fed has.
All right, so we've got just about maybe a minute or so left here. Frederick, before we let you go, is there a case to be made? A lot of folks, economists, are talking about this idea that interest rate policy has a long and variable lag. I've heard that term a lot now these days. Is there a case to be made that
bears on here where they're like inflation is not beat, and then they get people who come on and say the exact opposite.
That we see policy impacts in as little as 3 to 6 to 9 months as opposed to 18, like Kelly pointed out before?
I really don't think so. I think that the lags are pretty long. And that's one of the reasons why it's not easy to be a central banker, that you've got to call the shots and sort of call the shots now for what you think is going to happen a year to 2 years from now. So I think that that's the age-old problem that central banks have, which is that they have to try to anticipate the future. It's not easy to do so. You can make some big mistakes that the Fed actually did make in this recent cycle. But that's just the job. It's part of what you have to do. And in fact, this is also an indication that you're operating under uncertainty, that sometimes you have to actually ask which of the balance of risks that you think are much more dangerous. And in this particular episode, not getting inflation under control right now is actually quite dangerous.
Sure.
So that's what I really worry about. And also the political pressures that are going to get much worse on the Fed. There are also people talking about raising the inflation target, which I think is not the right time to do so.
Okay. All right,
Bitcoin
perfect.
losing
All
of its gains from earlier today. Holy. Back below 18K on Bitcoin.
Don't go anywhere.
5 minutes, T-minus 5 minutes until he comes out.
There's so much space.
Oh boy, I'm excited. Oh, this is where the market does some fun stuff. This is where it gets fun.
Expired. Expired. Expired.
Thanks, Aunt Bonnie.
It's a lot of house. I hope you can keep it clean.
At least Geico makes bundling our home and car insurance easy.
Which helps us save a lot of money.
Oh, Teddy, did you get my friend request?
I'll have to check.
Aunt Joni's here.
For bundling made easy, go to geico.com.
Perfected
We
by
got our lower
Geico
low on the S&P in this little micro trend that we've been at. Let's see. So if you go short, stop loss is up here
Introducing
at 405.
crafted
I
cocktails.
think that might be a decent play because we have broken trend. A purely price action standpoint.
Oh, that's normal.
Quad witching, I believe.
Kia, movement
Friday.
that inspires.
Or this Friday, I should
Kelly's
say.
is serving up big
Quad
savings
witching,
this
oh
holiday
boy.
season. Make holiday food prep a snap. Save up to 40% on select GE appliances at Kelly's holiday sale with store discounts and rebates. Get special financing and free shipping too. Save now at Kelly's.
Oh, hey.
What's going on over here?
We're shopping for a new car and driveway. They've got one of the largest inventories of new and used vehicles anywhere, and they deliver right to your driveway.
Not bad. But do they have a 7-day money-back guarantee?
Yeah, no, they do. It is super chill. Yeah, check out this convertible.
I love that for you.
Yeah.
What is that?
A Coco Train. You want some?
Driveway. Buy or sell a car from your happy place.
Experience the taste of well-cared-for local cows. Ground beef,
Experience the
ribeye, T-bone,
taste.
and so much more. Individual cuts, beef boxes, quarter, half, and whole beef. Located in Salem and online at betterbeefcompany.com.
Emotion, especially panic, has no place in investing. When we panic, we don't think clearly, and that leads to mistakes. If you associate your stock's value with
Tell
the
me
price
about
a
it,
stranger
Jim.
throws at it, it's
What's
easy
Coinbase
to
going to
panic when the
320 a
bid is
share,
low.
Jim?
When volatility strikes, focus more on its value than the price being put on it.
Oh, what's up,
Keep a
Jim?
level head. Make rational decisions.
Jimbo.
Just realize there'll be a better time to
Jimbo
sell.
Kramer. He knows where stocks are moving.
Scan the code or go to
He's who I look up to.
Welcome back. Let's get the lay of the land as we wait the
AMD,
Fed Chair's news
boy.
conference.
Oof.
It starts in just a couple of minutes.
God
time.
dang.
We saw stocks. We'll talk to Mike Santoli down at the New York Stock Exchange. Mike, we saw
So
stocks
we've just been getting
immediately
lower
sell
highs
and
mixed with
yields
lower
pop a little
lows
bit
on AMD.
Decision. Everyone seems to think if Powell were to lean one way,
Yeah,
hawkish would be that
AMD
way.
looks like it
but,
wants to go
there's
down.
still a risk he could open
Really
the door
looks like it wants to go down right now.
use some language about needing to soften the pace depending on how the data comes in or something to that effect.
Sheesh.
Without a doubt, Kelly. I mean, he can certainly acknowledge progress in various areas on inflation, those that he laid out not too long ago in that speech that the market took heart in. So, yes, I do think there is that opening. I think what the market is initially reacting to is not just the higher projected Fed funds rate where it's going to get to next year, but also in combination with the economic and inflation forecast that the committee put together, right? So they're saying growth is going to be worse than we thought 3 months ago, 0.5% GDP growth. That's as close as the Fed's going to get to predicting recession. And meanwhile, core inflation higher than we thought just 3 months ago. So that combination is unsettling. If they think inflation is going to be even higher while growth slows down, unemployment has to go up into the mid-4s is what they're saying. And even with that, they're going to keep Fed funds above 5%. Now, all that is subject to the markets disagreeing with it and deciding to take the other side. And you've been pointing out, and I think it's in all investors' heads, that 1 year ago, the Fed was very wide of the mark with what the outlook was going to be and what they were going to have to do. So at some point, you can fight the Fed if you feel as if their premises are not necessarily realistic.
But Mike, you can fight the Fed, but you're not going to do it from a career-long or short perspective if you don't have more data, right? I mean, is there anything that we're going to see between now and, say, the early part of January, February, as we head into the next part of the interest rate cycle in the early part of next year that breaks the market out of any part of the range that we've already seen for the past 2 or 3 months?
Well, I think what you can see, Dom, is, first of all, the PCE inflation numbers, as people are trying to put them together in advance, they're going to show decelerating core inflation. So people are maybe going to be able to gain some comfort that inflation does have some downside momentum, and therefore, the Fed may not have to go as far as they thought, or maybe growth can be more resilient. So I think that every data point is going to be filtered through, this set of expectations that the Fed committee has put out there. And look, we've absorbed a lot. The stock market's in the same place it was when the Fed funds rate was at 0.75%. back in the spring. So it's not as if every tick in what the Fed funds rate does immediately takes value out of the market.
Bearish consolidation pattern.
How we're getting there and how much longer we have to wait.
Consolidating bearish lead on this downside.
Just got a couple seconds left. What's the one thing you'd be watching for in the press conference, Mike?
I would say he's going to say we're not done. He's going to talk about higher for longer.
Yeah, he's going to say exactly what he always says every time.
He gives a nod to the CPI data we got yesterday.
Every time.
He's willing to exclude the rent calculations from inflation expectations. In other words, to try and say maybe now finally it's time for a more nuanced view of inflation.
Oh, it's a TikTok guy. A TikTok trader guy just walked past.
Let's get a quick look at the market as we wait.
Geezer looks like Einstein.
The Nasdaq's down about 0.8%, as you can see right now. The Dow less than that, interestingly, down about 0.4%.
Yeah,
and
course,
crude oil still hanging on to its gains, with WTI up about 2.5%. We saw a pop in bond yields, Dom, as well. Immediately after the decision,
dollar consolidating bullishly
on the 10-year, and there we still are sitting right around those levels, around 354.
Hardly doing anything.
All right, and what we have right now, you can see right there on your screen, Fed Chair JPowell approaching the podium right now, so we'll take you to his comments live right now.
So now, we are not
Good afternoon.
Bullish until we can get back above 405.47.
Before I go into the details of today's meeting, I'd like to underscore for the American people that we understand the hardship that high inflation is causing, and that we are strongly committed to bringing inflation back down to our 2% goal. Over the course of the year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do.
Exactly. We haven't felt them. We haven't felt the effects yet. It takes up to a year to feel them.
Of our economy.
But we won't know until towards the end of next year.
Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by a 0.5 percentage point. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive policy stance for some time. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Although real GDP rose at a pace of 2.9% last quarter, it is roughly unchanged through the first 3 quarters of this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment.
There's no way. There's just no way the market does what they do.
As shown in our summary of economic projections, the median projection for real GDP growth
right now. I'm thinking
stands
puts,
at just 0.5% this year and next,
here we go.
Well below the median estimate of the longer-run normal growth
Bearish
rate.
Consolidation with the push down.
Despite the slowdown in growth,
but we are oversold on the RSI right now on the 5-minute, but that kind of doesn't even matter during these days.
Job vacancy is still very high and wage growth elevated.
So, oh no, the RSI
job gains have been robust, with employment rising by an average of 272,000 jobs per month over the last 3 months. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year,
there goes SPY.
The
there goes
labor market
NASDAQ.
continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in October, total PCE prices rose 6%. Excluding the volatile food and energy categories, core PCE prices rose 5%. In November, the 12-month change in the CPI was 7.1%, and the change in the core CPI was 6%. The inflation data received so far for October and November show a welcome reduction in the monthly pace of price increases. But it will take substantially more evidence to give confidence that inflation is on a sustained downward path. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has contributed to upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.6% this year and falls to 3.1% next year, 2.5% in 2024, and 2.1% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a 0.5 percentage point, bringing the target range to 4.25% to 4.5%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.25 percentage points this year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Over the course of the year, financial conditions have tightened significantly in response to our policy actions. Financial conditions fluctuate in the short term in response to many factors, but it is important that over time they reflect.
Where's the NASDAQ bouncing? Oh, look at the
policy restraint that we're putting in place.
Look at that perfect bounce off that trend line, bro. Are you serious right now?
We are seeing the effects on demand in the most interest-sensitive sectors of the economy.
That's not even the correct trend line.
It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 50 basis points today, a step down from the 75 basis point pace seen over the previous 4 meetings. Of course, 50 basis points is still a historically large increase, and we still have some ways to go. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 5.1% at the end of next year, a 0.5 percentage point higher than projected in September. The median projection is 4.1% at the end of 2024 and 3.1% at the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we will continue to make our decisions meeting by meeting and communicate our thinking
meeting by meeting. We're going to do this thing.
We're taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations.
Drop a like, guys, if you enjoy the stream. Share it.
Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the long run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. You just talked about the importance of market conditions reflecting the policy restraint you put in place. Since the November meeting, the 10-year has declined by 60 basis points. Mortgage rates have come down. High-yield credit spreads have come in. The economy's accelerated, and the stock market's up 6%. Is this loosening of financial conditions a problem for the Fed in its effort and its fight against inflation? And if so, do you need to do something about that, and how would you do something about that? Thank you.
So as I mentioned, it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place to bring inflation down to 2%. We think that financial conditions have tightened significantly in the past year.
Price bouncing.
But
We'd
our
be
policy
bouncing.
actions work through financial conditions, and those in turn affect economic activity, the labor market, and inflation. So what we control is our policy moves and the communications that we make. Financial conditions both anticipate and react to our actions. I would add that our focus is not on short-term moves, but on persistent moves. And many things, of course, move financial conditions over time. I would say it's our judgment today that we're not at a sufficiently restrictive policy stance yet, which is why we say that we would expect that ongoing hikes would be appropriate. And I would point you to the SEP, again, for our current assessment of what that peak level will be. As you will have seen, 19 people filled out the SEP this time, and 17 of those 19 wrote down a peak rate of 5% or more, in the fives. So that's our best assessment today for what we think the peak rate will be. You will also know that at each subsequent SEP during the course of this year, we've actually increased our estimate of what that peak rate will be. And today, the SEP that we're published shows that, again, that overwhelmingly FOMC participants believe that inflation risks are to the upside. So I can't tell you confidently that we won't move up our estimate of the peak rate again at the next SEP. I don't know what we'll do. It will depend on future data. What we're writing down today is our best estimate of what we think that peak rate will be based on what we know. Obviously, if the inflation data come in worse, that could move up, and it could move down if inflation data are softer.
Gina.
Gina Smilik, New York Times. Thanks for taking our questions. The SEP, like you mentioned, suggests that the Fed will be making another 3/4 percentage points worth of rate increases in 2023. I wonder if you would foresee that being in 25 basis point increments, 50 basis point increments, sort of how you see the speed playing out going forward. And then I wonder what you're looking at as you determine when to stop.
Yeah. As I've been saying, as we've gone through the course of this year, as we lifted off and got into the course of the year, and we saw how strong inflation was and how persistent, it was very important to move quickly. The speed, the pace with which we're moving was the most important.
And we're
thing.
back, and the market's back to going green.
Coming to the end of this year, we've raised 425 basis points this year, and we're into restrictive territory. It's now not so important how fast we go. It's far more important to think, what is the ultimate level? And then at a certain point, the question will become, how long do we remain restrictive? That will become the most important question. But I would say the most important question now is no longer the speed. So, and that applies to February as well. So I think we'll make the February decision based on the incoming data and where we see financial conditions, where we see the economy. And that'll be the key thing. But for that decision. But ultimately, that question about how high to raise rates is going to be one that we make looking at our progress on inflation, looking at where financial conditions are, and making an assessment of whether policy is restrictive enough. I've told you today we have an assessment that we're not at a restrictive enough stance, even with today's move, and we've laid out our individual assessments of what we would need to do to get there.
They're not restrictive enough.
At a certain point, though, we'll get to that point, and then the question will be how long do we stay there? And the strong view on the committee is that we'll need to stay there, until we're really confident that inflation's coming down in a sustained way, and we think that will be some time. Now, why do I say that? If you look at you can break inflation down into three sort of buckets. The first is goods inflation, and we see now, as we've been expecting really for a year and a half, that supply conditions would get better, and ultimately supply chains get fixed, and demand settles down a little bit and maybe goes back to services a little bit, and we start to see goods inflation coming down. We're now starting to see that in this report and the last one. Then you go to housing services. We know the story there is that housing services inflation has been very, very high and will continue to go up, actually, as rents expire and have to be renewed. They're going to be renewed into a market where rates are higher than they were when the original leases were signed. But we see that the new leases that the rate for new leases is coming down. So once we work our way through that backlog, that inflation will come down sometime next year. The third piece, which is something like 55% of the index, PCE and core inflation index, is non-housing related core services.
Are we rejecting?
And that's really
past support becoming
market,
present
the biggest
resistance?
cost by far in that sector is labor, and we
looking
we
like
do see
it.
a very, very
Can't
strong
reclaim
labor market.
$399.20.
One where we haven't seen much softening, where job growth is very high, where wages are very high.
That was a lot of value,
quite elevated, and
volume
really is an imbalance
to the
in
upside
labor
on
market
that
between
candle.
supply and demand.
Holy.
So that part of it, which is the biggest part, is likely to take.
I think it's just going to be a red bloodbath for the rest of the day once this guy stops talking.
The goods inflation has turned pretty quickly now, after not turning at all for a year and a half. Now it seems to be turning, but there's an expectation really that the services inflation will not move down so quickly, so that we'll have to stay at it, so that we may have to raise rates higher to get to where we want to go. And that's really why we are writing down those high rates and why we're expecting that they'll have to remain high for a time.
See? They're trying to scare people. It's all about inflation expectations, not so much actual inflation.
You described GDP growth in the SEPs as moderate or modest, I believe. Yet it's really approaching stall speed. Half a percentage point is not much. Labor market unemployment rate as representing some softening, but it's nearly a full percentage point rise, and that's well in excess of what has historically been associated with recession. Why wouldn't this be considered a recessionary projection by the Fed?
Well, I'll tell you what the projection is. Rate of unemployment is actually elevated at this moment, so it's not clear that those forecasts of inflation are really much above the natural rate of unemployment. We can never identify its location with great precision, but that 4.7% is still a strong labor market. If you look, you've got the reports we get from the field are that companies are very reluctant to lay people off, other than the tech companies, which is a story unto itself. Generally, companies want to hold on to the workers they have because it's been very, very hard to hire. So, and you've got all these vacancies out there far in excess of the number of employed people. That doesn't sound like a labor market where a lot of people will need to be put out of work. So that there are channels through which the labor market can come back into balance with relatively modest increases in unemployment, we believe. None of that is guaranteed, but that is what their forecast reflects.
Thanks, Nick Timmeros of the Wall Street Journal. JPowell, I want to follow up on Gina's question. The decision to step down the pace of rate rises appears to have been socialized at your last meeting, largely before the past two CPI reports showed inflation decelerating in line with the committee's forecast this year. You just now talked about making decisions meeting by meeting and being mindful of the lags of policy. Does that mean, all things equal, you would feel more comfortable probing where the terminal rate is by moving in 25 basis point increments, including beginning at your next meeting?
So I haven't made a judgment on what size rate hike to make at the last meeting. But what you said is broadly right, which is having moved so quickly and having now so much restraint that's still in the pipeline, we think that the appropriate thing to do now is to move to a slower pace. And
slower pace,
that will allow us to feel our way and and get to that
I love
level,
how it
we
goes
think,
up on
and,
just
and
one
better
sentence.
balance the risks that we face. So that's the idea. It makes a lot of sense, it seems to me, particularly if you consider how far we've come. But again, I can't tell you today what the actual size of that will be. It will depend on a variety of factors, including the incoming data in particular, the state of the economy, the state of financial conditions.
With the CPI report that did come out last week, do you think it would change some of those forecasts in today's SEC?
Can't hear this person.
No, absolutely not. No, as a just a matter of practice.
Lower
the
high and a
SEP
lower low now
reflects
on
any
NVIDIA.
data
We've broken
that
that
comes out during the meeting.
little
And
uptrend that
participants
we've
know
had
that
for
they
a
have
very
the
long time
awareness that
on
they
NVIDIA, where we're
can
just getting
make changes to
higher
their
highs,
SEP
higher lows, higher high,
during the
higher
meeting.
low, higher high, higher low, higher high.
Well in advance of the press
Or
conference,
lower
so
high,
that we're not running
higher
around.
low, consolidation,
But
break,
that's not the
higher
case.
high,
It's never
higher
the
low,
case that,
higher
that,
high,
that
higher
the
low.
SEPs don't reflect an important piece of data that came in on
Now
the
we
first day
got
of the
a
meeting.
lower high and a lower low on NVIDIA. Where do you think we're going to go from here, folks? I don't know.
Hi,
You
Chair
tell
Powell.
me.
Rachel Siegel from the Washington Post. Thank you for taking our questions. I'm wondering if we could talk about the projection for the unemployment rate. Why has the Fed raised its unemployment projection? Is it because the model suggests that a higher terminal rate would automatically cause a higher unemployment rate? Or are you seeing signs that the labor market isn't quite as strong as we think it is now? Thanks.
No, it's not about the strength of the labor market. The labor market is clearly very strong. It is more just that, by now, we've continually expected to make faster progress on inflation than we have ultimately, and that's why the peak rate for this year goes up between this meeting and the September meeting. You see the fact that we've made less progress than expected on inflation, so that's why that goes up, and that's why unemployment goes up, because we're having to tighten policy more. And so it didn't go up by much in the meeting, I don't think, but that's the idea, is slower progress on inflation, tighter policy, probably higher rates, probably held for longer, just to get to where the kind of restriction that you need to get inflation down to 2%.
In order to get to that number, how much of that could be caused by layoffs versus vacancies trimming or changes to the labor force population rate?
It's very hard to say. You can look at history, right? And history would say that in a situation like this, the declines in unemployment would be more meaningful, I think, than what you see written down there. But why do we think that is the case? So I'll give you a few reasons. First, just is that there's this huge overhang of vacancies, meaning that vacancies can come down a fair amount, and we're hearing from many companies that they don't want to lay people off, so that they'll keep people because it's been so hard. I mean, I think it feels like we have a structural labor shortage out there, where there 4 million fewer people, a little more than 4 million, who are in the workforce available to work than there's demand for workforce. So the fact that there's a strong labor market, means that companies
Apple down
will hold
2%
on to
right now,
workers,
but the
and it
S&P
means
only down
that it may
1%,
take
Nasdaq
longer,
only down
but it also
1%.
means that the costs in
Must be
unemployment may be
Microsoft.
less. Again, that we're going to find out empirically, but I think
yes,
that's a reasonably possible outcome.
Tesla.
And you do hear
Tesla
many,
could just not stop
many
selling
labor
off right
economists
now. It's
believe that it
actually
is.
insane.
So we'll see, though.
Thank you. Colby Smith with the Financial Times. How should we interpret the higher core inflation forecast for 2023 in the SEP? Does that not then suggest that the policy rate currently forecasted for next year should actually be higher than the 5.1 medium estimate penciled in?
Well, I think that's why one of the reasons it went up was that core came in stronger this year. Yeah, what you see is our best estimate as of today, really, for how high we need to raise rates, to how much we need to tighten policy to create enough, restrictive policy to slow economic activity and soften the labor market and bring inflation down through those channels. That is the estimate, best estimate we make today. And as I mentioned, we'll make another estimate for the next SEP, and we'll, of course, between meetings we do the same thing, but we don't publish it.
Hi, Victoria Guida with Politico. I wanted to make sure I understand specifically what's going on in the SEP, because you all expect rates to go higher, but you're also more pessimistic
Watch we
about
rally in
what
the close.
inflation
I
is going to look
guarantee
like
it. We're
next
gonna
year. And I
rally
was
in the
just wondering,
close.
given
Trap
that
some
we
more
have seen some
bulls.
cooling in inflation,
Oh,
is
gosh.
that
Oh,
primarily
gosh.
because of wage growth, that you expect wage growth to be sort of a headwind?
And we're going into next year with higher inflation than we had thought, right? So we're actually moving down to the level that we're moving down to
High
next
or
year is
low
still
on the
a very
S&P?
large drop in inflation from where inflation is running now, well more than a 1% change in inflation. But remember that the jump off point at the beginning of the year is higher. So we're moving down still by a very large chunk. I don't think the policy's having any less effect. It's just starting from a higher level at the end of 2022. So we're getting down. I believe the median is 3.5%. That's a pretty significant drop in inflation. And where's it coming from? It's coming from the goods sector.
Just right
clearly.
into another bear flag.
By the middle of next year, we should begin to see lower inflation from the housing services sector. And then, the big question is how much will you see from the largest, the 55% of the index, which is the non-housing services sector. And, that's where you need to see, we believe you need to see a better balancing of supply and demand in the labor market so that you have, it's not that we don't want wage increases. We want strong wage increases. We just want them to be at a level that's consistent with 2% inflation. Right now, if you factor in productivity estimates, standard productivity estimates, wages are running, well above what would be consistent with 2% inflation.
Thanks. Hi, Chair Powell. Neil Irwin with Axios. Some of your colleagues have been pretty explicit that they can't imagine rate cuts happening in 2023. That's certainly not implied by the SEP. But futures markets have priced in some easing in the back half of next year. What's your view of the likelihood of any kind of rate cuts next year? What circumstances might make that plausible?
Our focus right now is really on moving our policy stance to one that is restrictive enough to assure a return of inflation to our 2% goal over time. It's not on rate cuts. And we think that we'll have to maintain a restrictive stance of policy for some time. Historical experience cautions strongly against prematurely loosening policy. I guess I would say it this way. I wouldn't see us considering rate cuts until the committee is confident that inflation is moving down to 2% in a sustained way. So that's the test I would articulate. And you're correct. There are not rate cuts in the SEP for 2023.
No rate cuts next
Steve
year.
Matthews with Bloomberg.
No cuts. No pivot
let me ask
next
you
year.
About China. In the last few weeks, China has abandoned its COVID policy and been reopening pretty strongly. I'm wondering if you see that as disinflationary because you're seeing supply chains improve, or inflationary because it obviously brings a lot more demand globally, improves the global outlook for growth and for commodities prices.
More bearish consolidation.
So you're right.
Here.
Those two things will offset each other. Weaker output in China will push down on commodity prices, but it could interfere with supply chains ultimately, and that could push inflation up in the West. It's very hard to say, how those two will offset each other, and it doesn't seem likely actually that the overall net effect would be material on us. But to your point, China faces a very challenging situation in reopening. We've seen waves of COVID all around the world can interfere with economic activity. China, a very critical manufacturing place for manufacturing and exporting. Their supply chain is very important. And China faces a reopening. They've backed away from their COVID restriction policies. There could be very significant increases in COVID, and we'll just have to see. It's a risky situation. But again, it doesn't seem like it's likely to have material overall effects on us.
Hi, Chris Rugaber at Associated Press. Thank you for taking my question. I wondered if you could comment a bit more about yesterday's inflation report. I mean, it showed inflation cooling in all three of the categories that you laid out at Brookings. Are you confident that you're seeing real progress on getting inflation under control? Are you still worried it could slip into some kind of unentrenched, upward spiral? Thank you.
Right. So the data that we've received so far for October and November, we don't have some of we have some remaining data to get in November, but they clearly do show a welcome reduction in the monthly pace of price increases. As I mentioned in my opening statement, it will take substantially more evidence to give confidence that inflation is on a sustained downward path. So the way we think about this is this. This report is very much in line with what we've been expecting and hoping for. And what it does is it provides greater confidence in our forecast of declining inflation. As I mentioned, we've been forecasting significant declines in overall inflation and core inflation in the coming year. And this is the kind of reading that it will take to support that. So really, this gives us greater confidence in our forecast rather than at this point changing our forecast. In terms of the pieces, we have been expecting goods inflation to come down as supply chain pressures eased. That's happening now. Housing services, as I mentioned, there is good news in the pipeline as long as new housing leases show declining inflation. That will show up in the measure around the middle of next year, so that should help. And the big piece, again, is core services ex housing, which is very important. And we have a ways to go there. You do see some beginning signs there, but ultimately that's that more than half, as I mentioned, of PCE core index. And it's very fundamentally about the labor market and wages. If you look at wages, look at the average hourly earnings number we got with the last payrolls report, you don't really see much progress in terms of our average hourly earnings coming down. Now there may be composition effects and other effects in that, so we don't put too much weight on any one report. These things can be volatile month to month, but we'll be looking for wages moving down to more normal levels where workers are doing well and ultimately their gains are not being eaten up by inflation.
Excuse me, Michael McKee from Bloomberg Radio and Television. There's a little bit of a disconnect between the optimistic view you just expressed about the economy and the changes that you've made in the SEP. And I'm wondering if you're reacting to the fact that the markets have loosened financial conditions, or if you feel the Fed may be a little bit behind on inflation, whether in the recent disinflation we're seeing is transitory or not, and how this affects the idea of a soft landing if you're projecting just 0.5% growth for this year.
Yeah. So John Spy here.
If I think I got your question. So, one thing is to say is I think our policies
rallying to close.
In a pretty good place now. We're restrictive, and I think we're getting close to that level of sufficient.
Fake out, big market fake out right here.
We laid out today what our best estimates are to get there, it boils down to how long do we think this process is going to take, and of course we welcome these better inflation reports for the last 2 months. They're very welcome, but I think we're realistic about the broader project. So that's all. That's the point I would make. It's we see goods prices coming down. We understand what will happen with housing services, but the big story will really be the rest of it, and there's not much progress there, and that's going to take some time. I think my view and my colleagues' view is that this will take some time. We'll have to hold policy at a restrictive level for a sustained period, so that two good monthly reports are very welcome. Of course, they're very welcome, but I think we need to be honest with ourselves that there's inflation. 12-month core inflation is 6% CPI. That's 3 times our 2% target. Now, it's good to see progress, but let's just understand we have a long ways to go to get back to price stability.
Well, do you think the soft landing is no longer achievable?
No, I wouldn't say that. No, I don't say that. I mean, I would say this, to the extent we need to keep rates higher and keep them there for longer and inflation, moves up higher and higher, I think that narrows the runway. But lower inflation readings, if they persist in time, could certainly make it more possible. So I don't think anyone knows whether we're going to have a recession or not. And if we do, whether it's going to be a deep one or not. It's not knowable. And certainly, lower inflation.
Tell us about it, pal. Wow, look at that. Look at Spies ripping back up
would increase the likelihood of a. So I would put it this way: of a a return to price stability that involves significantly less less of an increase in unemployment than would be expected given the historical record.
Hi, Chairman Powell. Brian Chung, NBC News. You warned Americans of pain earlier this year as the Fed hikes rates, but with the Fed now expected to raise rates higher than you thought when you first said that, just wondering where we are in that pain. How would you describe that to Americans if the projections on unemployment find themselves? That would be 1.6 million Americans out of jobs.
So the largest amount of pain, the worst pain would come from a failure to raise rates high enough and from us allowing inflation to become entrenched in the economy so that the ultimate cost of getting it out of the economy would be very high in terms of employment, meaning very high unemployment for extended periods of time, the kind of thing that had to happen when inflation really got out of control and the Fed didn't respond aggressively enough or soon enough in a prior episode, 50 years ago. So that's really the worst pain would be if we failed to act. What we're doing now is, it's raising interest rates for people. And so people are paying higher rates on mortgages and that kind of thing. There will be some softening in labor market conditions. And I wish there were a completely painless way to restore price stability. There isn't. And this is the best we can do. I do think, though, that and markets are pretty confident, it seems to me, that we will get inflation under control. And I believe we will. We're certainly highly committed to do that.
Thank you, Mr. Chair. Grady Trimble with Fox Business. You've reiterated today, and the committee has reiterated its commitment to that 2% inflation target. I wonder, is there ever a point where you actually reevaluate that target and maybe increase your inflation target if it is stickier than even you think it is?
That's just so changing our inflation goal is just something we're not thinking about. It's not something we're not going to think about. We have a 2% inflation goal, and we'll use our tools to get inflation back to 2%. I think this isn't the time to be thinking about that. I mean, there may be a longer run project at some point, but that is not where we are at all. The committee, we're not considering that. We're not going to consider that under any circumstances. We're gonna keep our inflation target at 2%, and we're going to use our tools to get inflation back to 2%.
Back to 2%. Back to 2%.
That was fussy.
Thank you, Chairman Powell. Nicole Goodkind, CNN Business. As you monitor wage growth and unemployment data, I wonder if you're paying close attention to a sector or even income level. Like, how do you factor potential exacerbations of inequality into your risk calculations, especially given the K-shaped recovery of 2020?
So I would go back to the labor market that we had in 2018, 19, 20. So what that looked like was wage increases for the people at the lowest end of the income spectrum were the largest. The gaps between racial groups and gender groups were at their smallest in recorded history. All of that because of a tight labor market. A tight labor market which had inflation running, just a tick below 2%, and the economy growing right at its potential. So that seems like something that would be really good for the economy and for the country if we could get back to that. And so that's what all of us want to do. We want to get back to a long expansion where the labor market can remain strong over an extended period of time. That's a really good thing for workers in the economy, and we'd love to get back to that. That's what our goal is. There's in the near term, we have to use our tools to restore price stability, but we can't. What we have to think about is the medium and longer term. If you think about it, the country went through a difficult time. I think much more difficult than we can think it would happen here, but it really set up our economy for several decades of prosperity. So price stability is something that really pays dividends for the benefit of the economy and the people in it over a very, very long period of time. And so when it is lost for whatever reason, it has to be restored and as quickly as possible, which is what we're doing.
This is boring.
We do. Yes, we absolutely do. We look at it's our regular practice to talk about unemployment rates by different groups, including racial groups and that sort of thing. We do. We keep our eye on that.
Yep. Hi, Nancy Marshall-Genzer with Marketplace. What would you do if the economy slows so much that we enter a recession before we see strong, consistent signs that inflation is slowing? In other words, stagflation.
Good question. Stagflation. All right.
So I don't want to get into too many hypotheticals, but you know, it's hard to deal with hypotheticals. So let me just say that we have to use our tools to support maximum employment and price stability. I've made it clear that right now the labor market's very, very strong. You're at near a 50-year low. Where you're at or above maximum employment, in 50-year low in unemployment.
Guy's going crazy. Now we're rallying.
Nominal wages are very
Told
high.
y'all.
So the labor market is very, very strong. Where we're missing is on the inflation side, and we're missing by a lot on the inflation side. So that means we need to really focus on getting inflation under control, and that's what we'll do. I think as the economy heals, the two goals come more into play. But right now, clearly the focus has to be on getting inflation down.
Got to get back above 405 if we want to continue the uptrend on SPY. And it looks like it could happen.
Thank you,
Oh my
Powell.
goodness,
Greg
look at
Robb
this.
From Market Watch. You spoke a little bit ago, you said that the U.S. it looks like we have a structural labor shortage in the economy. Could you expand on that, talk a little bit more about that? And really, are you talking about getting Congress action on increasing like illegal immigration, things like that? Thank you.
So what I meant by that,
the
structural labor shortage is
we
if
go
you
down.
look at where we are now, as I mentioned.
Bounce around here for the rest of the entire week. You never know. This is a pretty big range, not for today, but
actually working.
That's about a $10 move there that the S&P
Are you
made.
in the labor market? Are you looking for a job or have a job? And you're more than 4 million people short. We don't see, despite very high wages and an incredibly tight labor market, we don't see participation moving up, which is contrary to what we thought. So the upshot of all that is the labor market is actually, it's 3.5 million people at least smaller than it should have been based on pre-pandemic, just assume population and reasonable growth and age of the
market going
population.
crazy.
Our labor force should be 3.5 million.
Holy
more than it is, and
bears trapped?
There are lots of easy ways to get to bigger numbers than that if you go back a few more years. So why is that? Part of it is just accelerated retirements. People dropped out and aren't coming back at a higher rate than expected. Part of it is that we lost 500,000 people who would have been close to 500,000 who would have been working who died from COVID. And part of it is that migration has been lower. We don't prescribe, it's not our job to prescribe things, but I think if you ask businesses, pretty much everybody you talk to says there aren't enough people. We need more people. So I tried to identify that in a speech I gave a month ago, but I stopped short of telling Congress what to do because they gave us a job, and we need to do that job.
Jennifer. Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You say you expect growth of just 0.5% next year. Given that you've said the process of raising rates and getting inflation back under control will be painful, have you had discussions within the committee and addressed how long and or how deep of a recession you would be willing to accept?
No, I mean, what we do is we make our forecasts and we publish them quarterly. And if you look at those forecasts, those are forecasts for slow growth, for a softening labor market, by which I mean unemployment goes up, but not a great deal. And you see inflation coming down. You see rates going up a lot. You see inflation coming down. Those are those forecasts, and that's really what they show. We're not.
SPY's just going to close flat.
We all, of course.
Look at this. Look at the wick on that candle. Jeez, please.
Talk about
right back up to that level. Look at this key level.
This
boy.
kind of
God,
of a recession and that kind of a recession. We make those forecasts. The staff runs, and you will see this if you look at the old teal books, runs alternative simulations of all different kinds at every meeting, and we look at those too, and those will explore different things. But that's just
on the system.
Upside and downside scenarios. Of course, that's responsible practice that we've carried on for many decades. But no, we don't. We haven't asked ourselves that question.
Go to Gene for the last question.
Last question. Okay.
Hi, Jean Young with Market News. I wanted to ask about the SEP again. If you are reaching peak rates around 5% in the first half of next year and inflation starts to decline materially, that would seem to make the real rate gradually more restrictive. Is that something that's built into the projections and into models? Is that something you would want to see?
Good question.
So we do know that, of course, that's something that we know and we'd see. But as I mentioned, we
Powell's like, yeah, we fucking know that, lady.
See the committee cutting rates until we're confident that inflation is moving down in a sustained way. That would be my test. I don't see us as having a really clear and precise understanding of what the neutral rate is and what real rates are.
So this is a lower high if we do not get back above 405.50, boys. Do not get faked out here.
In the event, it'll be a
Don't let them do it to you. This could be a big trap. Big trap.
Inflation's coming down in a sustained way.
Yeah, trap to one side, trap to the upside. It's just the market this year, boy. It's just on another level.
Well, you'll find out my opinion in the recap.
Yeah, me, Kevin.
All right, we're going to get right into it. Okay, wow. Jerome Powell today was like a dad who's mad at you for having kicked somebody's butt, and he's yelling at you. He's like, how dare you kick that kid's ass? How dare you do that? But he's got this little smirk on his face. He's kind of like, how dare you? Because he's kind of proud of you. And in this case, the fight is CPI. It's like, yeah, CPI is coming down. Kick its butt, right? Kick it down. And he's kind of like proud. He's like, yeah, that's my son, right? But he's also like stern, like, but don't do it again. Like, don't mess up CPI. You know, so that's what it felt like today. Like today,
all right.
Honestly,
I think I'll end the stream on that. That's it. We got our freaking 50 basis points. We got the kind of new information that they are not going to, at least they don't think they will drop rates throughout this entire next year of 2023, so that gives us a new little roadmap. They're thinking rate cuts, hopefully by the start of 2024. So yeah, rate hikes are always bearish. Keeping rates high for that long is, in my opinion, pretty bearish. But we shall see from here. Like I said, we got to get back above 405. That is the only way we can make a higher high right now. We are just putting in a higher low. We could just consolidate in a bearish way over here in this range from 405 to 396 today and tomorrow. We got 20 minutes left in the market, but I don't imagine a whole lot more will be happening. We shall see as the market digests what Powell just gave us. But yeah, that's all I got. Thanks for watching the stream, guys. I hope you enjoyed. If anyone watched, drop a like and a comment. Hit the subscribe if you want to subscribe. We'll see you later. Adios.